Hello, and thank you for joining us today. You're probably thinking this isn't David Moore, and you are totally correct. So David sends his regrets for not being on the webinar today, but I am here to break down all of your 1031 burning questions that you have. My name is Tina Colson, and I've been with Equity Advantage for 3 years now. And my previous background has been in real estate, finance, and also working in the charitable giving sector for folks who donate real estate. And I truly believe that real estate can be one of the greatest investments a person can make. So, a little housekeeping. If you need credit today, please watch for an email from Cecilia Moore, cmoore@1031exchange.com. She will be sending out those credit hours. And also, there is going to be a tab on the right-hand side of the screen for questions. Please type in those questions and we will get back to you with everything that you need. So with that, let's get started. So what is 1031 exchange? The roots go back to 1921, and the exchange is an IRS authorized process where like-kind business or investment property can be exchanged without immediate tax liability to the property owner or the exchanger. So let's go over who benefits and what doesn't qualify for the exchange. So the first one in general is anybody who has held an investment property for a period of time who wants to sell that investment property and purchase another investment property to hold, they will qualify for that exchange. Some of the exceptions for real property held for sale is if you maybe flip homes and you're looking simply to purchase a property at a lower cost, use your sweat equity, and then turn that property quickly. That does not apply for 1031. Application for certain partnerships. In this specific case, Section 761 or Subchapter K, this could be groups, partnerships, in that realm, sometimes a REIT situation where you're going in and you're trying to purchase directly into an LLC membership. That does not work for 1031. And then finally, the special rules for foreign policy. So you can exchange US property for US property. You can exchange foreign property for foreign property, but we cannot exchange US property for foreign property or vice versa. So those rules apply. Let's talk about a few exchange fallacies. So like kind does not mean house for house, land for land. It refers to the nature of the investment instead of the form. So you can go from vacant land to a commercial property, multifamily, single family. You can even go into passive investments. So all of that will qualify. Section 1031 does not specifically require a 2-year hold. We're going to go over a few things on that end today. And then there is no limit to the number of properties that you can sell or purchase within an exchange. You can carry a note, so seller financing is another topic that we'll cover. Land sales contracts, again, you can still do the 1031. You do not have to replace the debt in an exchange. This is another piece where we get a lot of questions where people say, well, I have to have an equal mortgage. No, you really don't. And we'll get into the details of that. And then lastly, 1031 is not all or nothing. So you can defer as much as you want in an exchange. You can pay a little bit of tax or you can defer all of the tax. So what is gain? This is another big question that we have. So gain is nothing to do with profit. Today, we actually see some phantom gain going on, which we'll talk about as well. But what is gain? Gain is the adjusted sales price of a property minus the basis. Basis is your purchase price plus your improvements that you have not expensed on your taxes already, less the depreciation. So again, phantom gain is where your sales price is going to be less than your debt on that property. And I have an example coming up in this presentation, which is now. So If debt exceeds the basis, you will have gain. In this instance, debt amount becomes the sales price. So your basis is $250,000 in the property. Your debt, because you've leveraged that property to the maximum, is now $350,000. This is going to issue a situation where you've got gain on $100,000. So what's your tax hit on the gain? The amount of gain you pay on the state and the type of tax you are exposed to. Each state has its own state tax on top of the federal tax. So if you're looking down below, we have got the appreciation federal level at 20%. Oregon could be 9 to 12%. And then you've got depreciation at 25%. Also, if you are in a high income tax bracket, you may end up with the alternative minimum investment tax, as well as the healthcare tax of the 3.8%. So as you can see, this could be significant in the long run. So let's look at per state. When you are charged with the state gain, it's going to be in the state in which that property was sold. So as you can see across the map, you can go anywhere from no tax to California, which is 13.3% tax. So again, that tax can be significant. One other piece that we talk about a lot in our industry is Section 121. This is the universal exclusion of gain. So this is on somebody's primary residence. And there are a lot of times where we may have a combination of the 121 and 1031, which I'll go over an example. So the taxpayer's gross income should not include gain from the sale or of an exchange property if that taxpayer has lived in their primary residence 2 of the preceding 5 years. So let's look at the limitations. The amount of gain excluded from the gross income respect any sale or exchange should not exceed the $250,000, or if this is a married couple, you have a $500,000 limitation. And again, this is if they're filing joint tax returns, both parties are on that property. And so there's some different scenarios that apply, but this applies to one sale or exchange every 2 years. So what are you selling? For the real estate agents out there, this is a key question to ask your clients is how long have they, lived in the property? If it was a primary residence, if it's 2 years, they'll have that universal exclusion. If they are selling it as a rental property, if they lived in it the preceding 2 of 5 years and then rented it for 3 years prior to sale, now they could qualify for both the 121 and the 1031 exchange. So as we look at the 2 property types, Section 121 is a primary residence. You can sell, you can get your exclusion of gain, you can sell that property anytime after that 2 years to qualify. There is no other time period involved on that sale. You can receive the money in the bank, not a problem, reinvest it. You have your equity, which is not relevant in this point. But if you look at the Section 121, or excuse me, the Section 1031, it must be a property held for investment at the time of disposition. You have, again, exchange of the property that you can take that 121 deferral of tax on. In this case, you've got your tight timelines, 45 days from the time of disposition and closing to identify the property that you want to purchase. You've got a total of 180 days from that closing date to close on any properties identified. So you cannot have constructive receipt of funds in an exchange. It must go through your exchange facilitator, be held by their account. And also you must, for full tax deferral, have equal or greater value in the new replacement property that you purchase. You've got to reinvest that net equity, that cash proceed that you received from the sale. Again, for full tax deferral, you want to invest all of it. And then a loan of at least equal value. Again, cash may be placed in lieu of a mortgage. So here's an example of a combination 121, 1031. So you've got a married couple. They are filing jointly, and they purchased a primary residence several years ago for $200,000. They lived in the home for 8 years, and then they decided to purchase a new primary residence. So they have now rented that former residence for a period of 2 years. It was paid off, so it is all equity in the home at this point. And their current home value, they're looking to sell, it's $800,000 with an adjusted basis of $175,000. This is going to give them $625,000 in gain in this example. So again, ask the question, how long did they live in the house and at what time frame? So they did live in the home for 2 years out of the preceding 5, and they can use both 1031 and 121. So their options, their first option is to solely go with the section 121. They sell the property, they get their exclusion of gain up to $500,000, and then they pay tax on the remaining $125,000. If they go with option 2, they can purchase at an equal or greater amount for full tax deferral. So they're going to do the exchange, purchase another investment property for equal or greater value, take the $500,000 cash at closing of the relinquished property, and then just defer the balance of tax through the exchange. Option number 3, they're going to go down in value and still have tax deferral. So how does this happen? They're going to exchange the property, purchase another investment property at a lower value of $300,000. They're going to use the cash from the sale to keep the additional $500,000. And now they don't have tax exposure because, again, they've got that $500,000 exclusion of gain, which allows them to do that. So why, again, exchange, why this is so important? So the IRS wants to see investors using that extra capital to go across or up in value. So in this scenario here, we have a property that is sold for $750,000, and the adjusted basis is $300,000 at the time of sale. That's going to give $450,000 in gain. So what is the impact of tax? If their federal, state, and depreciation recapture is at 40%, that's $180,000 cash out of their pocket. So if you skip down below, and we're looking at the general sale, and they're using, so again, they've got a $750,000 sale, they've got a remaining loan balance of $250,000. So that's going to be $500,000 cash in this scenario. For a general sale, if they are paying tax of $180,000, that's only going to leave them with $320,000 to move forward with that new purchase. Whereas if you look at the exchange and we're deferring the tax, that $500,000 is still in their pocket to use toward that next purchase. So if each investor uses 25% down with that cash that they have in hand, the person with the general sale is only going to invest in $1.28 million, whereas our exchanger is going to be able to invest in a $2 million property. So let's look at the 4 cornerstones of the exchange. Cornerstone 1. In an exchange, something must be given away and something is going to be received. So the property being relinquished, again, you want to hold it for investment a minimum of a year. At the time of sale, it also must be an investment. So most investors, again, we're going up in value. So maybe you're going from 1 door to 2 doors. Cornerstone number 2, items relinquished and received must be of like kind. We hit a little bit on this earlier. So you can sell anything from a single family residence to purchase multifamily property, commercial, vacant land. All of it will apply. You can even go into passive investments, Delaware statutory trust, oil and mineral interests. So all of these things will apply so long as it is being held for investment. Cornerstone number 3 is the napkin test must be satisfied. So some people think that you only have to cover the gain in an exchange to be fully tax deferred, and that is untrue. So let's look at a couple examples here. So in example number 1 and 2, our value, equity, and mortgage on property A, which is going to be that relinquished property, your value of $700,000, equity of $400,000, and a mortgage of $300,000. In example 1 for full tax deferral, they are going up in value to purchase property B, so up to $950,000. They're using the same cash that they received from the sale, $400,000 in equity, and then they're getting a mortgage to offset the difference between the two, so $550 in mortgage. That will give a person full tax deferral. So let's look at example 2. So again, property A, we've sold it for $700,000, but now we're going down in value by $50,000. You're still using the same equity of $400,000, and your mortgage is $250,000. So again, you're going down in value, which is going to give $50,000 in boot. Boot? No, it is not a pair of boots. It is tax. So boot is unlike property received in an exchange. It's personal property, cash, reduction in mortgage after everything is said and done, and it's subject to tax. So forecasting this can help you structure your exchange. Replacing debt, you can offset mortgage boot with additional cash, but you cannot offset cash with additional mortgage. Here's an example of that. So if we sell a property for $1 million, you've got $500,000 in equity and $500,000 in mortgage. If you take replacement property A and you're still purchasing at an equal value, you're using $400,000 in equity instead of your $500,000. You're going up in mortgage by that $100,000 difference, which means you're going to have a $100,000 boot left over. In replacement property B for full tax deferral, again, you can purchase at an equal amount, and I apologize for the numbers being off here as I just noticed that. The equity in the property is going to be $600,000, so you're bringing in an additional $200,000 to closing, which is cash, and then you're going to have a mortgage of $400,000 left over. You're going to be fully tax deferred in that. So lastly, cornerstone number 4, there must be continuity of vesting. Taxpayer selling must be the taxpayer purchasing. Some examples of this would be, let's say a person has their primary residence, they get married later in life, and they purchase another home with their spouse at that time and decide to rent their first house. They're going to do an exchange and sell that first house now, where they are the only person on title. In this scenario, there are 2 options. Is one, if they are in a non-community property state like Oregon, they will have to sell as an individual and purchase as an individual in the exchange. Or their second option would be add their spouse to title prior to disposition of that property, and now they both can move forward in purchasing the new replacement property together. We deal also with partners in a transaction. Maybe there is a multi-member LLC and the partners are wanting to go their separate ways. In that scenario, we do what's called a drop-in swap, where we drop the partners out of the LLC. They're now tenancy in common as individuals, and then they can move across to do an exchange as an individual on the other side. If they are in a partnership and they want to move together in that exchange, then they can sell out of that LLC in that LLC's name and purchase in that same LLC name. So there are many different options that we go through and talk about when you call up for your consult, and this is one of them. So how about reducing debt? You can go down in value, which is going to, again, give you tax exposure, or you can also replace mortgage debt with additional cash, as we talked about before. So it is possible to reduce debt because they go down in those 2 ways. Seller financing. So a lot of folks will ask us about notes in an exchange and seller financing piece. So there are some different options that you can use with this. You can sell the note to a third party. You can use the note to acquire a replacement property on the other side and negotiate with that seller on that replacement property. A good example of this is, let's say you're buying a $500,000 home. You have $250,000 cash to put in toward that home, and your note is valued at $250,000. So if that seller is willing to use that $250,000 note, that will work in the exchange. You will have taxation on that note though. So the next one is you can purchase the note from Equity Advantage as you come into this. And if you purchase the note at closing, then you will be fully tax deferred. Also, a short-term note maturing before the acquisition of the replacement property, that is also acceptable. So sometimes there are moments where somebody will get a delay in their cash. They will take a note on that property, but they know that their cash is coming to offset that note again prior to the closing of that relinquished property. So in that case, we can hold the note, and then again, it's paid off prior to that replacement closing. And then also a partial exchange, usually only cash proceeds. The note will be considered boot. Payments on the note will receive installment sale treatment. So if you have further questions about notes in an exchange, we're happy to send you some information. Just send us something in the question box there. What type of exchanges can we do? We can do delayed. You're going to sell first and buy later. We can do a reverse exchange where you're going to purchase first and then sell later. This one we use a lot of the time as a backup plan just because it is a little more complicated. You can do an improvement exchange where you are purchasing property with the funds, the proceeds that you receive from your relinquished property in the exchange, and then we're also going to use any balance of proceeds toward improvements on that new property you purchased. And lastly, the leasehold improvement exchange is improving property that you already own. We can also do blended exchanges, so any combination of the above. In any exchange, you have a strong timeline. So it's 180 days total from the time of the first property closing. The first 45 days of that 180 is your identification period. So the identification period is crucial in the exchange, and there are no extensions to these timelines unless there is a disaster that occurs, and then the IRS will tell us what those extensions will be. Generally, if there's ice storms, tornadoes, again, any natural disaster, an extension will come into play at that point. So let's talk about the identification of replacement property. So within that 45 days, you've got 3 independent rules. And the first one is you can identify up to 3 properties or of any value. And so if you only want to purchase 1 or 2 properties, that 3 property rule is your best bet because again, it's the most flexible. You don't have to worry about the value on it. The second independent rule is any number of properties identified. If you go 4 or more properties, you need to add up the total value of all properties identified, and it should not exceed 200% of the value of the property that you just sold. So if you sold a $500,000 property and you've identified more than 4 properties, the accumulative value of those 4 or more properties should not exceed $1 million. If you're within the 200% rule, you have the option to purchase one or more of those properties. If you exceed 200%, now you are in the 95% rule, which is the final rule. And what that means is you would need to purchase 95% of all properties identified, or it will blow your exchange. So that one is a tough one. We have seen it go through, but very few people will use that rule. So what can happen in the 45-day window as you're identifying property, and when can we release the funds? This is not our rule. This is an IRS G6 rule requirement regarding the payment and payout of funds. So if you do not find a property within the 45 days that suits your needs and you do not identify, we can cancel your exchange on day 45 and your money is going to be released on day 46. The second thing that can happen, you identify property and for some reason it falls through in that 45-day window, you can always replace it. You've got total flexibility within that 45 days to name another property you wish to purchase. If you identify property and it falls through after day 45, now, if there's no additional properties that we can close on in that exchange, your funds are going to be tied up and released on day 181. Let's talk about a conversion of property. What do you want it to be? So you have multiple properties that you've accumulated over the years. And so maybe you want to sell 5 properties and you're looking to purchase one big property that you want to have as your primary residence someday. So, okay, this example, this is a fun one because we're going big on this one, but you can turn this new replacement property into a corporate event center or getaway for at least a year or longer and rent it out as such, and then you can convert it to your primary residence. So you've got a lot of options when it comes to what do you want that property to be. Is it going to be a primary residence someday? Is it going to be a second home? If you do make it a primary residence, just know that if you do an exchange, you make it a primary after a year plus of holding it as an investment, you do not want to sell it within a 5-year period of ownership, otherwise it's going to be fully taxable to you. So wait until after year 5. If you're in 6 or 7, now you've got the option to sell that property. You can take the universal exclusion of gain, you'll get a proration on that amount, and then you pay tax on the balance. The other option is you can always turn it back into an investment property for a period of time and then do another 1031 exchange on the full amount. So seasoning, how long is long enough? So 1 to 2 years, depending on the circumstance. We've had situations where folks have done an exchange and they have tried to rent the property out and they could not get a renter in that property. They had some financial hardships and therefore had to sell their primary home. They moved into the rental property in a 4-month period. That was deemed long enough by the IRS, just again due to their circumstance. We always suggest a year because it will take you from short-term to long-term gain rates. It shows your intent to hold for investment, which is the 1031 rule, and that's what it's all about. And also the 1-year time frame has been slated, but it just has not passed as a 1-year rule at this point. So again, we always suggest a year, if not longer, and depending on the circumstances, some have a strong 2-year hold. We'll talk about that in a minute, but always suggest talking with your accountant before you go into an exchange and sell a property. So second homes have a strong 2-year hold, and you also have some different rules around this. So if you've had a second home and you have not been using it much, you can go ahead and do the exchange with it. So the rules around this is you need to have it rented out for 2 years prior to disposition, or excuse me, you need to have it rented out 14 days per year for 2 years prior to disposition. And then also you want to minimize your use of that property to 14 days or 10% of the time that it is rented out for that 2 year prior to disposition. The same rules hold true on the replacement property. You want to rent it out for the 14 days or more. And again, do not use it for 14 days or 10% of do not use it more than 14 days or 10% of the time that it is rented out. So related parties. This is another one that we get quite often. So you can sell to a family member, but cannot purchase from a family member unless that family member has that property that they're selling as an investment property themselves. They are going to also need to do an exchange. So an example of this is a son cannot purchase from his mother's primary residence as an investment property through an exchange. That doesn't work because it was the mother's primary residence. However, if the mother also had that property as a rental property and not her primary, now son can go through an exchange, purchase mom's property that was an investment for her. Mom is also going to move forward and do a 1031 exchange and purchase another investment property in her area. And now both parties have to hold those properties for 2 years minimum. Dealer status. What qualifies dealer status? Here you've got 9 different questions that you can ask to see if you fall into that category. But basically anybody who is going to purchase property through an exchange and then try to flip it quickly, that is going to be considered dealer status. We don't do flip properties, but if you want to purchase a property, improve it, hold it for a year as a rental, and then sell, that's going to qualify for the exchange. So here's again the questions to ask. How is the property and the purpose for the property being acquired, the purpose which the property was held, the extent of the improvements made, the frequency, number, and continuity of sales, the extent and nature of the transaction of the property, business activities of the taxpayer, extent of advertising and promoting the property for sale, and then whether the property was listed with real estate broker or other outlets, and purpose for which the property was held at the time of sale as opposed to at the time of acquisition. So we're almost to the end here. We're going to go through a couple of opportunities. Again, we talked about using 121, 1031 in different realms. This is a little bit different example. So property owner lives on a farm. They decide to retire and sell the property. Basis is under 50,000. Property is now worth 1.2 million. They have a lot of gain. So what is the solution to this? The portion that was their primary residence can be taken in a percentage and they can get the universal exclusion on that compartment of that property, whereas the working farmland can be taken through the 1031 exchange and tax deferred if they want to purchase additional investment property with that. So we see this all the time. This could happen with COVID. We had a lot of folks moving from an office space to their home office. That home office could be considered 1031, and the primary residence component can go 121. If you've got a vineyard, it's the same scenario as this farmland. There's a primary residence on the property, take that percentage, go ahead and get the universal exclusion of gain on it, and take the rest of it 1031 exchange. Opportunity 2, again, what do you want the property to be for you after you have purchased it? So in this scenario, we had an investor owns a duplex. They really wanted to move to the desert and make a primary residence in the desert. So they sold their duplex. They purchased the property that they would someday like as their primary. They rented out that home for a period of time and then moved in. So now it is their primary residence. It is their retirement home. They planned on staying there for considerable amount of years. So this is a great scenario where that works well. And then also let's talk about your end game. So passive investments, Delaware statutory trust. You can do an umbrella partnership real estate investment trust. This is where, generally you'll have to go into it through a Delaware statutory trust. And by the way, the DST, as we call that, they are a multitude of properties that are going to be in one portfolio. You're going to be a percentage owner on that property. They're going to cycle through approximately every 5 to 7 years. And at the end of the cycle of that portfolio, you have the ability to exchange out of that property and into another portfolio or into property that you manage yourself again. The umbrella partnership or real estate investment trust, UPREIT, it has a little bit shorter cycle time, but you can only exchange into it. You cannot exchange out of it. It will turn to shares after about a 3 to 5 year period. And now you can sell those shares and liquidate as you wish, pay the gain as you go. The other one is oil and mineral working interests. So we've got some folks going into that sector as well. You are a percentage owner of a property or portfolio, and you have the ability to exchange in it and out of it. So that is what we have for your end games. And lastly, just going over our website review. So our sister company, IRA Advantage, a lot of folks use their IRAs to purchase real estate. This is a great way to do it. We can help self-direct your IRA so you can manage that and purchase other investments such as notes, loans, precious metals, and an abundance of other items that the law allows. Equity Advantage, 1031exchange.com. And then lastly, our Post 1031. Post 1031 was created about a decade ago for our investors to post property for free. So you can get a premium posting on there for very little change, but feel free to go on, register, and post your properties or seek out properties that you want to purchase. And this is a national listing site, so it gives great exposure on that end. We do have our YouTube channel with many webinars and other presentations on both the IRAadvantage.net and 1031exchange.com. So please check that out, and YouTube channels. Subscribe, like us, we love that. And again, for those of you who needed credit today, Celia Moore will be sending out an email, so watch for an email from cmoore@1031exchange.com. Again, I'm Tina Colson, Equity Advantage, IRA Advantage. It has been a pleasure to be with you today. And if you have any questions, please give us a call, 503-635-1031. Have a great day. Take care.